Today, we are going to speak about financial leverage. So let's understand together the concept of increasing risk or shifting our risk profile by borrowing. We call this the financial leverage. So let's take an example. Say you want to buy a house and the house is worth $100,000. And you go and then you pay for it in cash. The house then goes and then becomes worth $110,000. So you basically made $10,000 on your investment. That's 10%. $10,000 divided by $100,000. Let's assume now that instead of buying the house with cash, we go to the bank and we borrow $80,000. That means we put $20,000 down payment or 20%. We said it's the same house, nothing has changed. So the house now is worth $110,000. And for simplicity of things, let's ignore interest rates, time value of money, all of that. Let's just keep it simple. We just want to highlight the concept, which is very important. So it's the same house, and then now it's worth $110,000. How much equity, how much money now do we have in the house? Of course, with the bank, we still owe $80,000. So we now have, instead of the down payment of $20,000, our equity in the house, how much we have in the house, is actually $30,000. Interesting. So what happens to our money that we put? We put $20,000 and then now it has become $30,000. So how much return did we get? Is it the 10% initially that we got by buying the house entirely in cash? No, we actually got 50%, which is, the math of it is very simple. We made $10,000 of profit, and then we divide it by the initial $20,000 that we put. So that's 50% returns instead of just a 10% return. Returns have been amplified by 5 times. What is this 5 times coming from? Let me explain. We bought a house that is worth $100,000 and we put $20,000. That means we bought a house that is worth 5 times what we put. This 5 times is what we call leverage. We are 5 times levered. And because we are 5 times levered, returns have been amplified by 5 times. Instead of 10%, now we got 50%, which is the leverage times the initial 10%. Now you're going to be like, Abdel, well, this is amazing. I can just keep doing this and amplify my returns. This is great. Well, there is an issue. Because what happens in the other case, where what happens if the house goes down to from $100,000 to $90,000? Well, it's exactly the same thing, except it's on the opposite side. Instead of losing 10% of our money, we lose 50% of our money. So bottom line, financial leverage amplifies return, but also amplifies risk. Nothing is free. If you want more returns, you need to take more risk. Thank you so much for your support, and I will see you next time.